Hey everybody, it's Cowboy. We got Larry with us right now, and we did a show with him about a week and a half ago. And Larry, how you doing, bud?
I'm doing great. Glad to be back.
Yeah, it's good to have you. You definitely are taking on this whole algo thing, and that's a big deal. There's a lot of people who are even my clients who they go through the courses, and there's some pretty darn valuable stuff in there, but for some reason they just never get past the I'm still learning phase, and that's fine. I get it. We all have a lot going on. I'm not putting anybody down, but I am happy to see somebody actually taking it on. That's amazing. So, give me just a moment. I'm kind of scalping while we're talking. Let me bring up the scalp so people can just kind of see. Not what the hell is this? Okay, I know what that is. Weird. One of my old layouts got thrown up. Let's do this. Oh, not that one either. All right, we're going to flip this one here. Okay. Now, I think I get a little scalp going before we get started here, because this is a massive breakout, and it's a breakout, and it's a breakout. Now, FX markets are a bit slow today, and that is because we have CPI coming tomorrow, and so that, that can mean some trickiness. But I do have a possible trade just kind of showing up right now, and it's a very small scalperoo, but I would prefer to get either the bottom of this or wait for the breakout. So I'm not going to take it just yet, but I am going to set it up. And then where the stop loss is depends on how I take this trade and what it looks like. But this is a breakout, and essentially this is the pullback. So technically, after this consolidation here, this breakout would allow me to take this trade as is, should I care to. And then the stop loss would be below this little bit of a pullback here. The question is how far north can I go with this? We're going to take a brief look at the structure, and then we're going to get into Larry's algo. Now, Larry, you've been working on this pretty diligently from what I've seen. What's your experience right now, like with, working? How many back tests are you doing? How much time have you spent back testing, that kind of thing?
So for me, I'm a very hands-on person, and jumping into it, I wanted to be able to put application to what I was getting out of your module. So I was able to find 4 indicators that I could use that I had a basis knowledge of on how they affect how they reflect what market would be doing. I found 4, went back and back tested. I want to say year 2023, went through 2023 and had minimal trades, but I had a positive system. So then I wanted to use it in relatively newer market of 2025, try to dial it in a little bit. So I went back and back tested from January of 2025 to see if I could increase the amount of trades while keeping my expectancy rate and increasing my trades and keeping my percentage of wins, which I was able to do. And I wanted to make sure that that was consistent. So I continued and conducted 129 trades over the first 3 months of the year to see where I would lay out for Q1 on my portfolio. And I was at a expectancy of 5.1 over those 3 months with a win rate of 53%. So I feel like that's a good spot to then make the next move of now trying to optimize and understand.
With that 68%, do you know what your risk to reward was?
I standard risk to reward. Didn't look at structure, didn't look at trends. My standard risk to reward was a 2-to-1.
2-to-1. All right, let's talk a little bit about that. Right now, I got into this. It's already in a breakout. So we're looking at a breakout and pullback from a higher time frame consolidation, right? And it even pulled back, pushed up. And my algos do say I can take this. Even though we're in a little tiny consolidation, the algos say I can take it. Now, there's always that chance that this thing comes down and stops out. See how it's kind of poking back right now. But there's a decent probability it's going to head up. And this is a pretty small trade for me, but it's also 3.5 RRR. So we just had Larry discuss risk to reward, right? And basically, and this is on the USD JPY that I'm taking this trade. So what a risk to reward means is that when you're trading like an adult, I don't mean buying meme coins and, thinking that you're going to get rich. I mean trading like a professional does. You're going to have a place where you get in, a place where you get out. It's pre-planned, it's set up. You've used data science to determine where that is because you have studied whatever asset you're trading. And then you're going to have a place at the bottom of this green and red box. If price goes below that, you exit the trade. And then you have what's called risk. So in this particular case, Larry, are you going on a $10 or $20 risk to test?
I'm doing a $10. So I win
$10.
20, I win and I lose 10. It was a standard scaling of a $1,000 account.
So for Larry, for example, right? So really that you're doing a 1% risk, risk. We'll talk about that. So this is a risk to reward ratio of 2 to 1. This is how professionals trade. So as you enter a trade, if price goes down below here and you're out of the trade, you're going to lose $10 because this is a test account. So Larry's just putting basically toy money on there to see how it goes. Now, if in fact price actually, let's fix this to make it easier to see. Give me 1 second. If price goes up to target where you actually end up getting out of the trade up here, then you win, or I should say Larry wins $20, right? And that's only because we're judging everything based on the risk. So what we do is the stop loss, which is where you exit the trade if it goes against you, that's all based on market structure. Just like I did with this little scalp down here that's already in profit, by the way. This little scalp that I put on, I based it on structure on a very low time frame. So I went to a lower time frame because of the way my algos are. I can do this. I wouldn't recommend anybody else trade on the low time frame like I do. But because of the way that the market moved, I'm able to use this little bit of structure right there, where that little arrow is right here. This is scalping, folks. It's not recommended for most people, but that little bit right there, that structure allows me to put a stop loss below that because price probably won't want to go below that. Now, if it does, that's fine, and I'll lose the trade. Everybody loses trades all the time. But the idea is you win most of your trades. And when you win more than you lose. So it brings us back into the risk to reward conversation. In Larry's back test, what he did was he made sure that when he wins twice as much as he loses, right? So in the example of the scalp I just took, if price goes down, there's this bit of structure that I used market structure to determine there's this stop loss that goes right here. Now price may go below that and I may lose the trade and I lose $10 if I were playing at the testing level that Larry's at. However, if price goes to my target, I make $20. Now let's just say I win half my trades, right? Now half my trades are going to lose me $10. The other half are going to win me 20. So basically what you're looking at is, let's just say I take 10 trades, I win half, I lose half. I lose 50, but I make 100, right? So 5 trades at a $10 loss. Let's just do the math here. Take 10 trades, win 5, lose 5. When I win 5, I'm making 5 times 20, which is $100. If I lose 5, let's fix this here. If I lose 5, then I have lost $50 because I only lose $10. And if I have this total result, then I end up with $50 in profit, even though I lost half my trades, right? Now, this is just a test and there's nothing guaranteed. And, don't do this at home, kids, and all the, we're not giving investment advice. We're just talking about the calculation that traders use when they're, trading. So for Larry, if you're actually better than 50% in your testing, right? So as it stands right now, you're doing even better than what I just drew right here. And we'll talk, I don't think we want to get into expectancy because that's a little more advanced, but long story short, this is how we look at our whole thing. We say, am I winning more than I'm losing? Even if you're only winning half, you're still profitable because you win twice as much as you lose, right? Now, the trade little scalp that I just took, it's a little riskier. However, it's 3.5 to 1. What does that mean? Well, let's just say that I put $300 on that trade. Well, let's make it an even number. Let's just say $100, right? Just to keep it even. So if I have 3.5 to 1 like this, and I put $100 on this trade, that means that as price goes down, I've lost $100. If it goes against me, I lost 100, chalk it to the game. Now, if price goes in my direction and I win that trade, I've now made 350. Why? Because I risked 100, but it's a 3.5 to 1 risk to reward ratio. So the risk is 100. That means that if I lose $100, right? But in this case, the reward is 350 because it's a 3.5 to 1 risk to reward ratio. So I could lose like 2/3 of these and still be profitable, even more. I mean, I could lose, I don't know, probably 3 out of 4 and still be profitable. I probably wouldn't be very profitable, but easily I could lose less than half, or I could win less than half of these and still make money. So that is what we're talking about with that. Now, in the meantime, we're going to jump over to your algo, Larry, and we're going to talk about kind of how it works. We're going to talk about your experience over the last several days, because what we do is we go back through time, just like you talked about, and we look at the historical charts and we test how your algorithm behaved based on the historical charts. And TradingView, the program that we use here, has a function, we've talked about it before, we're not going to go over it now, that allows you to simulate those trades. And what were your results on this, Larry? I know you kind of just said it, but let's say it again so I can write it on the screen.
Okay, so for the month of January, I had 41 total trades. 22 of them won, which then gave me a 53% win rate. 53%. My standard,
we call that a hit rate in
okay, hit rate.
I mean, you can call it win rate, whatever, we get it.
And then my standard risk to reward was 2 to 1.
Right, we kept it simple. All right, so and you risked $10.
Correct, $10.
We already went through the numbers earlier, so 1%. We know what your basic wins were. You're winning, let's say 53%. Well, 41 total, 22 wins. So 41 by 22, 2 to 1, 10, 20. Okay, so 41 by 22. I could do this in my head, but I'm not going to do this in my head.
For a total?
Yeah. What's your total? Like, what did you win in that?
My total at the end of the month was $250.
And this is on a mythical $1,000 account. It's like a pretend $1,000 account, because we're just, we're not really.
Correct. It's a demo account with $1,000 of risking 1%.
Right. So, and now most people will risk 2%. So most people in your position would be doing $20 in a trade and not 10. So you'd have a $1,000 account that would have gone up by 500. I want to temper everybody, because it's really easy to get excited when you see numbers like this. Trading live is different than backtesting. So what's going to happen is we backtest, we get an idea of how it performs. We really get an idea of how our algo behaves. And that's what's key. And then as we forward test, we're going to forward test with very small amounts of money, really like this, like $10, whatever you can afford to throw away in the trash. And then as you live test, you're going to see how it really behaves. And quite frankly, you're going to see how you really behave, because that is where everything changes. It's not as much. There is a part of backtesting that will give you better numbers than you would get in real life. And it has to do with overfitting and, just technical limitations of backtesting. There's another part where when you backtest, you want to win. So you'll kind of oops, what did I just do? Whoa, hey, that's me. Hit the wrong button. There's another part where you will basically, like, you want to win. So every time there's like a question of, oh, might this go my way? You kind of make it go your way. That's a very common thing. It's called overfitting. So when you go from back testing to live testing, I really advise everybody to temper their expectation and understand that this might not be as sunshiny and get rich as you think it is. But this is the experience. And this is where a lot of people fail. The reason they fail is because they go from this back testing environment to live testing, and they realize they're not making anywhere near the money they thought they would, and they think that they have failed in their back testing. No, this is the process. This is how it is. You're going to get better. And part of the way you will get better is that as you live test, you're going to realize the weakness in the back testing and your algo, and you might end up building something that's a little bit newer that makes up for that weakness. And then you're going to test that, and then you're going to trade that. Because this kind of thing, like, look, there are people whose first algo is profitable. Happens all the time. I'm not saying that's not going to happen, but most people are not profitable without coaching. They're not profitable for 4 years. And that's just sticking with it. That's just sticking with it, learning the best you can, trading. Maybe you hire a mentor, maybe you don't. 4 years for people to become profitable trading, just so you understand. The other end of it is 90% of traders lose 90% of their money in the first 90 days in forex. And I can't imagine that, like, anywhere is any different, right? Like, I can't imagine that that's going to be any better in any other market. So understand that this is a process. And if you don't have the capability, the tenacity to stick with it through the learning processes, then you're gonna quit. And this is because your trading psychology is in trouble. So let's get back into the algo after the lesson here, and let's talk a little bit about the algo itself. Let's go through the process now, and we're going to get a little technical, folks. If you don't understand what this is, I know we don't have a ton of people watching right now, but we will have a fair amount of people watch after the fact. So if you don't understand this, it's okay. Just like watch it, be a sponge, learn by osmosis. Ask me if you have questions. That's fine. You can hit me in the comments. So the first aspect of your algo is for your MACD to, let's just say we're taking a long trade. So you want the histogram to be green, and this, let me make these easier for people to see. Give me 1 second. I'll go to this one. So that blue line is called the MACD line, and this orange line that I'm about to highlight right there, that is the signal line. Okay. So to go long, to bet on the price going up, if you will, the blue line needs to be above the orange line, MACD above signal, and the blue line has to be above this zero line. And the zero line is right here on the chart where that yellow line is. It's where the red becomes green, becomes red. Okay. So, like, for example, you can start taking longs, or at least you can start looking at longs right here, where the blue goes above this zero and it is already above here. And then you can't take longs after here. You're no longer taking longs right there. And that's just one of a few different aspects of the algo, right? So let's go ahead and do this. The next one is your stochastic RSI with some special settings, although I think you're using the default settings, and that's fine. So for you, it's the same kind of thing, right? The stochastic RSI, the K, which is the blue line here that I will also make easier to see. Let's do that for the D. And I'm going to go ahead and put some lines on here to make it easier for the audience to see. So you need for the K to be above D, which means the blue to be above the orange, right? Right here, these two lines. And you need the blue to be above this light blue line. You need to be above the 50 point. Is that correct?
That's correct.
So you can start taking longs as long as everything else lines up right here. And then you stop taking them like right here. Yeah?
Correct.
Okay. And that's easy, simple enough, very similar to your MACD. And I'm going to go ahead and get rid of these right here. Now we're going to look at something called the Williams percentage R. And for you, in this case, without using the numbers that are on here, you just need it to be above this line for longs, right? And for those number junkies, it means that the value has to be less than 50. Negative 50, less than negative 50. So, or I should say greater than negative 50. It's got to be between negative 50 and 0. Okay. So don't worry about the numbers though. The last one that even, just as simple as this prior one is that, and we'll make this easier to see as well. We didn't do that before. That's fine. So this one here, the blue line to be long, and this is a volume oscillator. You need the volume to be above 0%, right?
Correct.
It needs to be above that center line right there. Okay, so we know what the conditions are. And so essentially, for example, we're going to use a function on TradingView, and it's the replay function. This is the technology we can use to backtest. right? So in this case, right now, what we have here, the MACD is above 0, but you can't, you got the blue below the orange, so we can't take anything. We can't take any longs or shorts. So and by the way, Larry told me that his first condition he looks at, you told me it's going to be MACD. So we would need, if this blue crosses below the orange, we need it to go below this center line, or we need the blue to cross back above the orange, above the 0 line, right? So let's just see what happens. Okay, no goes. We might be headed to a bearish trade here. Okay, so as of this candle, we're not looking at the price. We're only looking at MACD. You got the blue below the orange, the MACD below the signal, and now it's crossed below the 0 line, right? So we know that that's lined up. Stochastic, this one's tricky. This one's a real trick one. It's not going to let you go because technically the blue has crossed above the orange. If you look real close, you see the blue crossed above here. So we actually have to go another candle and see if that gets fixed. That's too close to call. There you go. So now that this candle has ended, the blue is now below the orange. Let's see if the MACD is still lined up. Oh, it sure is. MACD below the 0 line, and you're red. Now let's look at, we're on shorts now. Okay. So meaning that we're betting on the price going down, right? So in this case, we have the Williams percent is below -50, which is a short entry, right?
Correct.
And then we have our volume oscillator. This doesn't matter long or short. The volume's got to be above the 50% on any trade. Above 0, I mean. Correct?
No, on shorts I had it below 0.
Well, okay, so volume oscillator, unless I'm mistaken, a volume oscillator is just volume. Volume doesn't mean long or short. So am I not thinking about this one correctly?
No, you might be. I probably just misread it.
Well, let's do this, because I might be wrong too. Let's go to the volume oscillator. Let's go to about this script. Now, this is really valuable, folks. You're going to want to pay attention to how I'm doing this, because this is how you learn how an indicator works. In the case that maybe you're not quite sure, you go and I'm going to open this up. This is our indicator, volume oscillator. You go to these 3 dots on the top right-hand corner, and you go to about this script. Volume oscillator, calculation, takeaways. Okay, so what to look for? When there's a noticeable increase in price, or in this case, a decrease in price, volume oscillator divergences can occur. These divergences often come with a decrease in general volume, which traders should be acutely aware of. When a divergence occurs, the fast volume moving average is reportedly below the slow volume moving average, and the volume oscillator is shown to be below 0 line. Divergences, especially in cases like the one above, can often serve as a warning to traders and signal that current price direction is weak. There may be potentially a trend reversal in the near future. Okay, so let's think about that. Volume oscillator divergences can occur, right? So I'll explain divergences in a minute, but what a divergence means is that price is moving in a direction opposite to indicators. Like price is continuing to go up, but the indicators are indicating that it wants to go down. So if price continues to go up as those indicators continue to indicate that price wants to go down, there's a really good chance that when price goes down, it is going to go down in a very big way. And that's looking long, right? So if you are betting on the price going down and you get a divergence, that's probably going to go against you and start heading up in a very strong way. That's how divergences work. So in this case, below the 0 line, which helps project insights to the price trend, determine whether or not this direction is strong or weak. Positive values are plotted above the 0 line. They suggest that there is enough existing market support for the price to continue in its current trend direction. Negative values are plotted below, suggest that there's a lack of market support, which points towards price being stagnant. So in this case, if this volume oscillator is above this 0%, it means that price is probably going to continue in the direction it's going. Okay, if that goes below here, then it might indicate the price wants to reverse in another direction. So in this case, if yours is a breakout trade finder, you need the market to support going in the continuous direction. So what we need to do to treat this indicator properly is it needs to be above this 0. You might find that your number is a little bit better in that case. And in this case, they are, right? We're on a short trade for this. We want to go short. Currently, it's above 0. There is enough market to support the direction going short. So for you, your algo is going to have this always be above 0 to support the given direction, because you are doing a continuation or breakout trade, not a reversal trade. That said, let's go ahead and see what happens as we enter our trade. Now, for your stop loss, you're using ATRs.
Correct.
And so now that we have an entry, we're going to enter in the next candle, which will open here. Stop loss will be at this ATR. It's a special ATR that you have calculated. We won't share that with people unless you want me to. And then that's where we'll get out of the trade. We're basing it on this blue line right there. That's an ATR stop loss. So the pink, whatever that color is, that teal line right there. So we're putting our stop loss right there. And then we do a 2-to-1 risk to reward ratio, where it just goes 2-to-1 like this. Right? And whatever happens, happens. Now, there's ways to incorporate structure. We'll talk about structure in a minute. We're going to do this example, and then part of our kind of consultation today would be, how do I use structure in this? And we'll get into that as well.
But now it's an adjusted ATR, so I had to let the candle open to see where that ATR adjusted.
Okay, so you don't do the ATR until the candle opens. You do the thing we talked about where the candle opens and you shoot a line?
Correct, yes.
Okay. So if that's the case, then this is going to change a little bit. I'm going to hit the play button and watch where this opens. I'm going to be ready with the line to shoot. Whoa, yeah. Well, we know you won the trade. let's go back. I hit the wrong button. Let's go back. Now, as I hit the wrong play button, but I'm going to get ready to put a line where this little, okay, so this gets a little technical, folks. Just bear with us. If your eyes are crossed, don't worry about it. You don't have to know all this. Just take it in, right? Just let your subconscious take in this information, and you can like figure it out later. All right. So that said, this right here is where normally a stop loss would be. But as I open the candle, that's going to change. I'm going to hit one button, candle opens, and as it opened just slightly lower, just a hair lower. So where I put the line is where this candle should be, or where I kind of moved this little blue line to is where this blue line will move to when the candle opens, right? A little bit lower than that. Down here. So we don't have to do this in live trading. Like that little exercise that I just showed you, that doesn't have to happen in live trading. Okay. And the reason is that, let's see here. Okay, there it was. It was right here. I was on the wrong candle. But basically, this is going to happen live time while you're trading. So it isn't something that you have to know how to do. Like you don't have to do the thing and shoot the line. And when you're actually trading, it's just going to be there for you. And you don't have to do this weird measurement where you got to get it exact. But when you're back testing, you have to understand how this works. And you have to understand that these things change with time, right? So if I hit the one button here, this could be just a hair higher, but basically I've got it where it needs to be. Okay, so now that we've established that, and again, go watch this like 9 times, you'll get it. It's not a big deal. You could even just put it where it was. You don't have to get that precise. It's up to you. But we're going to be precise. So now the first candle took us way into profit. Why? Because this is a breakout trade. We hit the play button and we just see what happens. And there you go. You won the trade. You won the trade in 3 candles. You just won the trade in like, I don't know, a few minutes, like hour and a half, actually. So there you go. That's a one trade. So the next question is, how would I incorporate structure into this, right? Well, let's get back to prior to the trade. I'm going to talk a little bit about structure. And structure is relative, all right? So when you're looking at price action, this is where it's a little bit of intuition. You got up, down, very clear movements, right? Your structure is always going to be at these points right here. All the pivot points are where your structure is. But the most important structure is that which is not covered by price. So this structure goes through this price, so it doesn't matter quite as much. It matters, but not quite as much. This structure shoots through this price right here, so does this one, so they don't matter quite as much. But this structure doesn't shoot through price, nor does this structure. And let's just say that we, had structure look like this real quick, just for, whatever. Then this structure down here also is not, like, you could shoot a line out and price doesn't cross it. These are structures that matter the most, where price does not cover it up. Sure, this is a pivot point, but it goes through price. It doesn't matter as much. So you always look left, and structure will give you clues, right? Right. So let's do a real example, or a real backtesting example. Let's look really at the price. The key thing here that kind of stumps a lot of people who are new to the game is that they don't know how to judge structure or identify it. And it's really simple. On the chart you're looking, it's highs and lows that are very obvious highs and lows that stick out where the pivot points are. You see here? Even this is a structure. That's definitely a structure. Here's kind of messy, so I would just kind of go to here. This clearly is structure, but then it gets eclipsed right away, so I go to here, right? So when you're looking back through time, you're just going to pay attention to what sticks out, right? And if you go back even further, you got this right here, this right here, and then it just kind of is messy and goes up, and then it almost kind of doesn't matter after that. Well, this one here is actually important, right? But then eventually, these structures don't matter quite as much because your pivot point shoots through price right here. So now your main structure that matters is right here, not all the way back there. So it's just about looking at the chart and looking at clear pivot points. That's what it's about, okay? That said, now we're going to get back into how this all works in your trading environment. And we'll put our ATR back on. Right, actually, we'll take it off. Okay, so in this case, we're talking about a trade that goes short. Your conditions lined up as of this candle. Your stop loss is up here. We know it's up there. We'll do the thing again. But look here. You have a very clear point of structure that is recent. Price headed down, bounced up here. Right? There's a little structure right here. Technically, it kind of matters. I mean, it did kind of come down here. So, but this is a breakout trade. So the only structure you really should care about is strong structure, major pivots, right? That's your pivot. You don't want to take profit past this point right here. You don't want to do that. There's a really good chance that price will come down and then bounce back up here. Now, it may not, might break through, but as you do your risk to reward consideration, right? You're going to have your short right here. And let's see if this still lines up. Yep. So this is our original stop loss right there. We know it's good. And you have a 2-to-1. Well, fortunately, your 2-to-1 doesn't, like, structure doesn't get in the way of that. Structure's right after that. It's almost ideal for this situation to be like it is. But let's just say you were doing 3-to-1, right? Instead of 2-to-1. Well, now you got a problem because this is major structure, right? That's major structure. So price is not going to want to go past that. There's no liquidity past that, right? There's nothing for the market to eat after that. So there's a decent chance that price is going to go towards your target, and then it's just going to, disappoint you. It might even go a little below, but then it goes like this and goes to your stop, right? We don't want that. So what we would do if you're doing 3-to-1 is I would adjust and I would front run that structure. I would go a little bit before. I wouldn't go right at the structure. I would go a little bit before that. And there's a couple ways to do that. But long story short, that's a safe way to do it. You don't want to try to fight structure, major structure. If anything, you want to see that structure. And if price consolidates, you want to start to look for longs. But if you're algorithmically trading, then that gets into a longer conversation that we're not going to have today. So we're going to hit play, and we know this trade wins, and it even dips below structure. But let's see if it goes even further. Nope. What did I just say? I didn't know this was going to happen. What did I just say? Right? That's structure for you, right? And then you would have round tripped this mother. You would have been round tripping. It means that you go all the way into profit, or at least a nice profit area, and then it goes all the way back to where you started. And in trading, once the move is made, that's it. You don't want to try to stick around and hope that it continues. You want to just get out. And if you're working, you may not have the opportunity to do that. If you're in the middle of your shift, you might not have had the opportunity to put your stop to entry to at least limit your loss, right? You might be in the middle of, for you, especially with your work, I don't want to out what you do, but your kind of work is not the kind that gets interrupted very easily, right? So
Correct.
in reality, this trade, if we just hit play, we'll find out what really happens. Let's go to that's just, you don't want to sit through that. You'd have lost your trade right there. You would have lost. So that's why structure matters. So if you're doing a 2-to-1, now there's a couple things that we got to talk about now. We know that you were using the volume indicator correct 50% of the time.
Correct.
So we got to go back and do it over using it properly. So for you, that volume, this one here, this purple one here, needs to be above the middle line. Is it the purple one? No, it's not. It's the
blue one. Correct.
The blue one's got to be above. Okay. It's got to be, because you're a breakout trader. So the market is already going in the direction that you want to go as you trade, right? So you're going to need that above, no matter what. And then everything else seems on point. This would have been for you a long trade. So let's just do another back test, because they're fun, because we get to pretend we win things. Okay, so we always start for you with the MACD. So we hit play until it turns green for longs. I mean, there might have been a short there, but we're just going to look for longs. And then the blue needs to be above this zero line. And now, after this candle, you now have your conditions. Histogram's green, blue is above. This is a very bullish scenario if you're looking only at the MACD. Now, we'll take a look here. This is good. K above D, and blue, and above this 50%. Now, a lot of traders that mess with stochastic RSI would think, oh, it's going to reverse. Well, guess what? That's not the way to trade this. And everybody trades it that way. That's not how it works. Stochastic RSI, the way it works, and we're not going to get too deep into this, but the way it's really made is that when these lines are above this 50, price is bullish. When they're below, price is bearish. That's how it's made to be traded. Now, yes, it is overbought, and yes, things do turn, but I've done videos to show you where just selling these overbought and buying these oversold will probably lose you money. I've shown you this before. We're not going to go over it today. In this case, you're good for long. Let's take a look at the purple, and you are above -50 for longs, so you're good, right? And then we know that our blue is below, so we need this to go above here. Well, actually, let's think about that. No, yeah, we need it to go above. So we can't enter this traded right now, that's for sure. We need this to go above the 0%. Okay, so we know it's back here. Okay, I hate when it does that. You got to be kind of patient. We got to let the candle complete, because the way that this thing works is that it lets you see the candle. So if I just be patient, one more click will do it. There you go. Now you can enter this trade, right? Now you're a little bit into the move, but double checking everything else should. Yep, this one here is tricky. Your stochastic is it above? They're meeting each other here. The reality is that this can't, I don't think this goes above 100.
Correct.
So, at that point, if it doesn't go above 100 and these things are slammed to the ceiling, I would take that trade.
And that's what I used as well too, because there was quite a few that I had that were at 100 for quite a while.
Yeah, I've worked with stochastic for years, so we know it's this candle. So as we're back testing, we're going to enter on that candle. So we need to go to the prior candle. Now the stop loss is going to be this purple line down here, right? So let's do this. Okay, so stop loss is the purple line, and we're going to be ready to shoot a line where it ends up as the candle opens. We know that that's close to where it's going to be. We know the candle is going to open right here. So let's just kind of get it there. And then we'll set up our 2-to-1 just so we can see what the trade looks like. What we might find, Larry, is that, I don't know, we might have to, as you start to use the volume indicator properly, if you're getting worse results with that and you're getting better results without using it, then there's two things that might have to happen. But I would say probably just stop using it.
Okay.
You've done 200 back tests. You had better results using it the wrong way. Now I probably would just not use it at all and see what those results are.
Okay.
And then I'd use it properly and see what those results are. If the problem with using it the wrong way is that whatever numbers you're getting are going to be possibly a false positive. It might be that using it the wrong way is correct, but I would have to test a lot more to see that. And volume in forex is also a little bit tricky. So let's just go ahead with this test. Okay, let's hit play. We'll see where the purple line ends up, and we'll move things where they need to go. Okay, just a little bit above where it actually started. And then we'll go 2-to-1. It's good. It's a little bit tighter. Okay. So hit play. Close enough for government work. Okay, now we're in profit. Still in profit. Still alive. Not looking good. It's not looking good, bruv. Still alive. Kind of. Okay, you lost your trade. So, no, you didn't. It didn't quite leave. You got right there. In real life, there's a good chance you would have lost that trade. But if I don't know. Technically, in this testing environment, you did not. But that's a little too close for government work or whatever you say. So okay. Now you really lost the trade. So what's going to happen is, again, now I guarantee you there was a nice short trade in here. If we go to your indicators, right about here, there is. And you'll notice, because I know you're talking about how, if I, change the way I do my MACD, then I might get more trades. Well, guess what? Your MACD didn't cross until right here. And notice this didn't move until it crossed. So even though technically you had a trade right here, there wasn't a whole lot of volume in your direction until it crossed. And here's what I think is going to be the case. Until you get across in your direction, the volume is not going to go. Look at this. Look at this. This is why I think you're going to end up just throwing out the volume indicator. And here's why. Because the MACD is giving you what you need. Watch this. MACD crosses up. You get a good trade, right? Back here. Oops. Back here, you get a nice long if you entered right here. But this doesn't cross all the way until here, and you're too late in the trade. Now here, MACD crosses down right here, actually. And you're not getting in for another candle if you're waiting for that volume. So your volume oscillator, there are some issues with that. It's too slow. Let's look at some more examples. Yeah, this one doesn't. This one's going to be a candle late. This one's going to be right on. This one is going to be barely. You'd be okay with this one. This one's going to be a candle. This could be like 2-3 candles too late. This one is going to be, well, you would have gotten into this one, I think, maybe. That's like 50-50. Honestly, man, I'm not sure that this volume oscillator is helping you. And then this is a really good example. You're going to have to test all these. You're going to have to test without it and using it properly, right? I'm just giving you a very small data set. It's not a complete data set. Everything I'm saying could be bullshit. But to just look at this small data set, you have everything. Oops. You have everything lined up for a trade right here, right? And it's a long trade. So let's go along here and let's do our ATR, stop loss way down here. Yeah, no matter what, this trade is not going to go well because there's not enough volume behind it. So there you go. Then maybe what you're doing is the way because you don't have enough volume behind these trades. One thing about your stop loss is that it's really very wide, but it tightens up when there's a lot of volume. That's very interesting. Yeah, I would say this, Larry. I would first test it the way that you intended to, with the volume doing what you want it to. You might consider going in here and shortening it up. So you might consider like shortening your long and short lengths a little bit, like to say 4 and 8. Because you'll find that when you do that, it'll give you a little bit of an edge. Right? So watch here. This crossed up right there. Yeah?
Yeah.
When I'm on the new settings. But if I go to 5 and 10, see how it's a candle later?
Yeah.
So I wouldn't go much less than that, though. I wouldn't go too much less than 4 and 8. But I would test at 4 and 8. Let's see what happens here. I want to see what happens right here. I would just gamble a little bit and test at 4 and 8. Yeah, it's not much of a difference in this case. Let's shoot a line. Crosses right there. Let's look at this again and go to restore to defaults. Yeah. So if not much of a difference, but a slight edge, I would test it at 4 and 8 instead of 5 and 10. Because this is your lagger, but you're a breakout trader. So that volume is what's going to matter to you. So I would test it with it as intended at 4 and 8. That's what I would do.
Okay.
And then about, and this is, and for future reference, we'll get into see if you have any further questions, but now I think you have your homework set out for you. Fortunately, you know a lot more, and this is backtesting, folks. Like, this is the beginning of learning how to trade. And Larry is just a badass because you're going to jump in and you're going to do it. You did all 200 of your back tests. Like, you literally sat at your computer for 3 days straight to get this done because you're motivated. And I wish all my clients did that. I wish all my clients did it even in 5 months, but they don't. That's fine. We got the cream rise to the top. It is what it is. So in this case, if you want to know how an indicator works, because there's like a trillion of them, you go to the top left-hand side of the screen, so it might be hard to see, but up here, you see this volume os. Okay, so you click on the 3 dots right here. You go to about this script, and it's going to tell you how it works. And again, limitations. It's always best to use multiple technical analysis indicators rather than sticking to a solid one indicator. You wouldn't want to rely on a single indicator for market analysis, which is why we suggest using multiple indicators. It's telling you to do what I tell you to do. But you can always read on, what these are, like how these work. And a lot of times when you go, and this is like volume oscillator, I think it's a trading view, like a standard one. very simple, but some of the more exotic ones will actually show you how they work on a chart too. So in this, it'll have a chart and it'll, show you how it works. So any questions before we send you back to I don't want to say to the drawing board, but back to work?
No, it definitely answered some questions that I had.
Awesome. Well, then I look forward to hearing from you again and about how you're, killing it and moving forward. And then we shall reconvene.
All right. Sounds good. Thank you, sir.
All right, brother.